Welcome to the deep dive. Our mission, as always, is pretty simple. We take the sources you give us, dig through them, and pull out the key insights you need nice and fast. Today, we are diving deep into the coal sector. We're looking at a company called Core Natural Resources, ticker CNR. Now, this is a relatively new player forged from that big January 2025 merger of CONSOL Energy and Arch Resources. And you sent this one over because, well, you need to get to the bottom of a really fundamental question. Is this company, CNR, the smart, staled-up future of coal, built tough for the long haul, or is it just the last big, bright flare from a sector that's, ultimately fading out?
We've crunched the numbers, look at the reports. So the basic facts first. CNR, trading on the NYSE. As of October 24th, 2025, the shares were sitting at $83.06.
Okay, right. Let's unpack that right away because, honestly, the sources paint a really interesting, almost contradictory picture here. On one side, you've got this company with huge assets, what the reports call a fortress balance sheet, and analysts are looking at potential upside, targets going up to maybe $95, even $120 per share. That's a pretty significant potential return.
It absolutely is. But like you said, that upside, it really hangs by a thread. The sources are very clear on this.
Yeah.
There's one major external geopolitical threat, these U.S.-imposed tariffs of 2025, that could just completely sideswipe their operational strengths. It could, frankly, cripple the business model, is the phrase used. And that would pretty much invalidate all those rosy cash flow forecasts.
Got it. So that's our job today then. We need to map out that potential, 43% upside against this massive, kind of unpredictable risk. Let's start with the basics, the core business itself. So CNR, it seems purpose-built for scale, yeah? And specifically for export markets, they're not really focused on the declining U.S. market, it looks like. It's all about international sales from these huge low-cost mines.
That's exactly right. Their entire structure is geared towards that global focus. You basically have two main operating segments. First is the mining side, the extraction dominated by the Pennsylvania Mining Complex, or PAMC. But arguably, the really key strategic piece is the second segment, the CONSOL Marine Terminal, CMT, down in Baltimore.
Okay, the terminal. Why is that so critical? Just location.
It's more than location, it's control. Logistics are everything in coal. CNR's advantage isn't just digging cheap coal, it's getting it onto ships efficiently. They own a piece of CMT, plus they have access arrangements at other East Coast ports and even Gulf and West Coast options. In this business, transport costs can make or break you. So controlling that path from the mine, onto the train, into the terminal, and onto the ship, that's a huge competitive advantage, a real moat.
Right. Logistics as the moat, not just the mining.
Okay.
And the products themselves. They're selling two main types of coal, correct?
Yeah. Correct. Two very different vital types. First, you have metallurgical coal, or met coal. This is the high-value stuff. It's absolutely essential for making steel. There's basically no large-scale substitute right now.
So that commands a premium price, I assume?
Exactly. Higher price, better margins.
Yeah.
Then, their second product is high calorific value thermal coal. This is the stuff burned for electricity. And while, yes, thermal coal use is dropping fast in the U.S. and Europe, it's still a massive energy source globally, especially in developing Asia. Think India, Southeast Asia. They still need a lot of it.
Okay, so that explains the industry dynamic. Even with the West phasing out coal power, global demand actually hit a record high in 2024, driven by places like India.
Precisely. India is talking about doubling its steel production, which needs huge amounts of imported met coal. And on the supply side for met coal, things look tight. Our sources say only about 3 significant new met coal mines are expected to come online globally before 2030.
Ah, so limited new supply globally.
Right, which should, in theory, support higher prices and better margins for existing efficient producers like CNR long-term, assuming, of course, they can get it to market.
And the merger itself, CONSOL and Arch coming together, was designed to capitalize on this, to be one of those low-cost producers.
Absolutely. The whole point was synergy. They targeted $150 million to $170 million in annual cost savings.
Is how?
By combining their best-in-sector portfolio, basically their biggest, most efficient mines like PAMC, Lear South, Black Thunder. These use longwall mining, massive automated machines underground, very high volume, very low cost per ton. That operational efficiency, that's their core strength, their lifeline, really.
Okay, so they've got the assets, the strategy seems clear. Who's steering the ship? There was a change at the top recently, right? October 8th, Jimmy Brock took over as CEO from Paul Lang.
Yeah, that was a very significant appointment. Brock taking over signals a real shift, I think, away from the deal-making phase of the merger towards actually making it work on the ground. Operational execution.
What's his background?
He's pure coal, a lifer. Spent over 40 years at CONSOL, started right down at the bottom as a mine foreman and worked his way up. He's an operator, not a finance guy primarily. His job is integration and efficiency.
And they faced a pretty immediate test of that operational skill, didn't they? Something at the Lear South mine.
They certainly did.
Yeah.
Right after the merger, there was a combustion event, like an underground fire basically, forced them to temporarily seal the mine, which is a huge deal, especially for a critical longwall mine like Lear South. But management seemed to handle it well. They were transparent. They hit their targets for safely re-entering the mine. And crucially, they confirmed the longwall equipment itself, which is incredibly expensive, wasn't significantly damaged.
Okay, so handling a crisis well. That definitely speaks to operational competence.
It does. It shows the team on the ground knows what they're doing.
So Brock's team is good at digging coal efficiently. What are they doing with the money they generate? The plan is to return, about 75% of free cash flow back to shareholders?
Yeah, that 75% figure is really telling. It screams mature industry. They're not seeing tons of amazing internal growth projects to reinvest in. So the strategy is run the current assets lean and mean and give the profits back to the owners.
Wait, 75%?
Mhm.
That sounds huge. Does that imply they see almost no good places to reinvest inside the business? Isn't that maybe a bit of a bearish signal for coal long term?
It's definitely a signal of maturity, absolutely, not growth. And how are they returning it? Mostly share buybacks. Q2 2025, they spent nearly $82 million buying back stock, and they've still got authorization for another, $817 million or so?
Mm-hmm.
The actual cash dividend is pretty small, just a fixed $0.10 per share each quarter. The real focus is shrinking the number of shares outstanding. That helps boost earnings per share later if coal prices cooperate.
All right, let's pivot to the financials then. What's underpinning these buybacks? Market cap is around $4.3 billion. Revenue looks pretty volatile historically, which makes sense for a commodity company.
Yeah, cyclicality is the name of the game. Pro forma revenue swung from nearly $6 billion in 2022 down to about $4.3 billion in 2024. And this is where you need to look closely at the numbers because it can be confusing. Right now, the reported accounting profits, GAAP net income, looks pretty weak. The trailing net profit margin is tiny, like 0.6%. And in Q2 2025, they actually reported a net loss of about $37 million.
A loss. But wait, how can they report a loss and still spend $82 million on buybacks in the same quarter? Where's that money coming from?
Bingo. That's the key difference you flagged in the sources. It comes from free cash flow, FCF. Remember, mining is super capital intensive. GAAP accounting includes huge non-cash charges like depreciation and amortization. FCF adds those back, showing the actual cash the operations generated. So despite that GAAP loss, CNR actually generated $131.1 million in free cash flow in Q2 2025. That's the real engine. The FCF is what funds the buybacks and gives them flexibility.
Okay, FCF is the number to watch. And speaking of flexibility, that balance sheet looks incredibly strong. Debt-to-equity ratio is just 0.10. That's really...
It's exceptionally low. That 0.1 DE is their financial fortress. It means they can weather storms, commodity prices crash, they hit the cushion, industry downturn, they survive. That's exactly what you want in a volatile sector like coal. So valuation-wise, the trailing PE ratio is basically useless right now, over 160x, because of that temporary reported loss. But analysts are looking forward. The forward PE is around 16x based on expectations that operations will normalize and commodity prices will recover.
Okay, let's move into our next section, Chapter 4, Market Sentiment. So how is Wall Street viewing this recovery story, this forward look?
Generally pretty positive. The analyst consensus is leaning towards strong buy or moderate buy. And those price targets reflect that optimism. The average target range seems to be between, say, $110 and $190 per share. Compared to the current $83 price, that implies potential upside of, up to 43%.
Wow, okay, 43% upside potential.
Yeah, and technically the stock chart looks pretty constructive too, trading above its 50-day and 200-day moving averages, which traders often see as positive signs.
But it's not all sunshine and roses, is it? The sources call CNR a battleground stock. There seems to be a strong counter-narrative here, especially looking at short sellers.
That's the other side of the coin, absolutely. The short interest is quite high, 5.75% of the public float. That means a significant chunk of investors are betting against the stock.
And that number's been growing.
Significantly. Just in the last reporting period, short interest jumped by over 15%. That's a big move. It tells you that skepticism is building. People are betting that this big, complex merger integration won't go smoothly, that they won't hit those synergy targets.
Okay, so a clear split between bullish analysts and bearish short sellers. What about who actually owns the stock? Let's look at Chapter 5, ownership structure.
Well, the vast majority is held by Institutions' numbers range from about 81% up to maybe 94%, depending on the source. But digging into that, it's mostly passive index funds. Think BlackRock, Vanguard, funds that have to own CNR because it's in an index, not necessarily because they're making an active bullish bet.
Right, passive money. So what about the people who presumably know the company best? The insiders, management board members. Are they buying?
That's where it gets really interesting and potentially concerning for the bulls. Insider holdings are very low, only around 1.4% to maybe 2.4% of the company. But even more striking is the activity, or lack thereof. Over the past 12 months, the sources show 0 open market purchases by insiders. None. But there have been 4 instances of insiders selling shares.
0 buys, only sells. That feels
Yeah.
significant. You have management talking about efficiency, a strong balance sheet, massive cash flow, analysts predicting 40% plus upside, yet the insiders themselves aren't putting their own money on the line. That's a disconnect.
It's a definite divergence, and it's something you absolutely have to factor into your assessment. Why the hesitation from those who know the business intimately?
Okay, let's pull the internal picture together before we hit the big external risk. This is Chapter 6, Risk Assessment. Summarizing the SWOT analysis from the sources. Strengths are clearly scale, those low-cost mines, the logistics network, and that rock-solid 0.10 debt-to-equity ratio.
Right. And the weaknesses. Primarily, it's the risk that they don't successfully integrate CONSOL and Arch, that merger execution risk. Plus, the simple fact that their revenue is tied to volatile commodity prices.
Okay, but the sources highlighted one risk above all others, not the long-term shift away from coal, but something much more immediate.
Exactly. The single biggest overhang, the thing that could derail the entire investment case, isn't the energy transition years down the road. It's immediate, unpredictable political action.
The U.S. imposed tariffs of 2025.
And we established earlier, CNR's whole strategy is built on exports.
Entirely.
Yep.
They are betting the farm on selling coal internationally. So if the U.S. government slaps massive new tariffs on goods from major trading partners, the reports mention scenarios like 155% tariffs on Chinese goods. What happens next?
Retaliation. Almost certainly. And what do countries often target in retaliation? High-volume, visible commodity exports from the country that imposed the tariffs, like U.S. coal.
So the U.S. tariffs China. China hits back by putting its own tariffs on U.S. coal, making CNR's product suddenly much more expensive for Chinese buyers, locking them out.
That's the direct risk mechanism. But it gets potentially worse. China is one market. What if the trade spat escalates? The sources mention a nightmare scenario, potential 50% tariffs on goods from India.
India, which you said is their key growth market for both met and thermal coal.
Foundational to their future growth projections. A 50% tariff wall going up against India could absolutely cripple CNR's strategic path forward.
So their core advantage, being a low-cost producer, could be completely nullified. It doesn't matter how cheaply they mine the coal if tariffs make it uncompetitive in the destination market.
Precisely. You could have the world's most efficient mine, zero debt, brilliant management. But if a government tariff suddenly makes your coal 50% or 100% more expensive than coal from Australia or Indonesia landing in India or China, your export model collapses. Overnight, it's an external risk they can't control. And it's why this geopolitical uncertainty is paramount. It has the potential to just completely invalidate those optimistic cash flow models and price targets.
Okay, let's bring it all together in our final chapter, Chapter 7. Conclusion. Synthesizing everything for you. The bull case for CNR is clear. It rests on those great low-cost assets, the strong free cash flow generation, the disciplined return of capital to shareholders, and the favorable supply-demand outlook for met coal globally.
Yep, that's the positive side. The bear case hinges on 2 main things. First, the internal execution risk. Can they actually deliver on the merger synergies, combined with that insider selling, which raises questions?
Yeah.
And second, overwhelmingly, that huge, unpredictable risk of a trade war escalating and hitting them with tariffs.
So where does that leave valuation?
Well, our educational discounted cash flow, or DCF model, which is just one tool, remember, suggests that if things go well, if management executes, and if global trade stays relatively stable, then an intrinsic value somewhere in the range of $95 to $120 per share could be justified. Compared to the current price, around $83, that does suggest potential undervaluation.
But, and this seems like a huge but, that valuation is entirely dependent on management hitting those targets and no major trade war disruption. You, as an investor, have to explicitly weigh that potential, say, 43% upside against the very real risk that tariffs could just blow up the whole forecast. So maybe the final thought to leave you with is this. You've got these bullish institutions, mostly passive index funds, on one side, and you've got bearish short sellers, and maybe more importantly, insiders who are selling, not buying, on the other. Which group do you think has the better read on CNR's actual resilience if a trade war really kicks off? That's the core question you need to grapple with.
Definitely something to think about. We hope this deep dive into core natural resources has been useful for you. And if you do want more analyses like this, breaking down company reports and market data, please remember to like this video and subscribe to the Stock Analytics AI channel.
Yeah, absolutely. And for members, that gets you access to our full playlist. Already got deep dives on all 500 S&P 500 stocks in there. Next up, exclusively for members, we're tackling the entire NASDAQ 100. Plus, members can request specific deep dives. Just drop the stock picker you're interested in down in the comments, and we'll get an analysis turned around for you. Membership is just $4.99 a month.
And one final, very important reminder. This analysis was generated by an AI system. It's purely for educational and informational purposes. It is absolutely not financial advice. Please always do your own detailed research or talk to a qualified financial advisor before making any investment decisions.